Hey everybody, welcome to week 2 of Accounting 1101. I got a lot of exciting accounting things to look at. We're going to add another layer onto our accounting foundation here and talk about how transactions really get entered into an accounting system in the real world. Believe it or not, chapter 1 was a little bit of a training wheels chapter. Not saying the things that we did in chapter 1 don't happen in the real world, but they don't really happen there to begin with. We got to learn about where a transaction gets initiated in the accounting system. So that's what we're going to look at in chapter 2. Let's just jump right into it. A lot of new things to talk about. We're saying goodbye to the cash bucket example. If you recall in chapter 1 of Solid Footing, we had the little bucket by the door, and a brother and his sister were putting money into it, and we had an accounting system to keep track of the money that was going into that bucket, coming out of the bucket. And then later on, we added in Dad, and he became a creditor to the bucket. And we kind of used our bucket example to introduce an idea called the accounting equation. And so think back a little bit and try to remember that. Very important. Assets equal liabilities plus owner's equity. We're bringing that accounting equation into chapter 2. We're never going to throw it away. We are getting rid of the idea of a cash bucket being the entire business stuff. Accounting equation, we're bringing along chapter 2, and he's going to be sticking around for quite some time. So keep that in mind. The T accounts, we're bringing those back too. Chapters 2 all the way to 6 in Solid Footing follow the same example business. It's called Gray Company. We'll have a few new accounts. We introduce every single chapter, and we'll talk about how those accounts work, how they fit into our accounting system. Today we'll talk about a brand new way to record transactions, and then we'll also introduce another accounting report during our time together in the video today. So Gray Company, I'll tell you a little bit about that. Gray Company is organized as a corporation. A corporation has stockholders or shareholders, and you think of mostly our large companies that we see, like the Walmarts and the Targets and the Starbucks and the Chipotles. All of those are organized as corporations. And they have millions of shareholders. And every shareholder in those businesses gets common stock to evidence their ownership in that business. Well, before in the cash bucket example, we just had owner's equity. And we said owner's equity is kind of showing the ownership amounts that the individual owners had in the cash bucket, right? Well, the problem with that is, if we have a million different owners, we'd have to have a million different accounts to keep track of everybody's claim. So common stock kind of helps us find a way around that. So that's why instead of having an individual claim account for every owner that has stock in a corporation, we just have an account called common stock. It works in the exact same way from an accounting standpoint as the claim accounts that we looked at in chapter 1, meaning that it goes up on the credit side and it goes down on the debit side. So when the company issues stock, we're going to go up on the credit side. There's more stock out there, the value of that stock. When the company takes that stock off the market, maybe they buy it back and retire it, and then we'd have a debit. And we usually don't debit common stock a whole lot. Most of what we're going to do is going to involve adding to it when people invest in the business. So that's kind of the first important little tweak and concept that we need to kind of get squared away there. This idea that our equity accounts, instead of tracking everybody individually like in a sole proprietorship or a partnership, now we got a corporation. We're going to track those investments with an account called common stock. Gray Company is also a merchandising business, meaning that they buy inventory from a manufacturer and then they sell it to the end customer. You think of a lot of businesses that do that. Best Buy, Walmart, Target, all of those are merchandising businesses. Gray Company, the exact same idea. So, I promised you some new accounts. I deliver on my promises. Here we go. New accounts. We're going to have a new asset account called inventory. And this might be a good point just to reemphasize the way I designed the notes and the PowerPoints in Accounting 1101. They're designed for you to print out. You can print those out at home and play along as I fill them out. You can fill them out. and we can all just have a grand old time doing accounting together in real time. Even though I'm sitting here making a video, you might be watching it, a week later. We can still kind of have that accounting togetherness that, that is so important to everybody. But anyway, we got some new accounts we got to talk about. You got an inventory account right here, and I'm just going to kind of fill in a couple of things just to practice, and you can do the same. Inventory. Things that a business buys with the intent to resell to a customer. If you go into Walmart, you look at the stuff on the shelves, that is inventory to Walmart. Kroger, stuff they've got sitting on the shelves, inventory. So we have to keep track of that from an accounting standpoint, obviously. On the asset side, if you remember from chapter 1, things go up on the left-hand side, which we know to be the debit side. If it goes up on the left, that means it has to go down on the right. So think about that for a second. If you're a business and you buy inventory and you stick it on the shelf, you have made inventory go up. You've increased your inventory. Hey, we'd have to debit inventory when that happens. Customer comes in and buys the inventory, takes it with them. We don't have that inventory anymore. Inventory needs to go down. Hey, that's a credit to inventory. So my goal is to get you to start thinking about things in those terms. How does an account go up or down? What's making the account go up or down? That's really the key to accounting. You're probably thinking to yourself, this guy's crazy. He's already given us 500 different keys to accounting. There's so many keys to an accounting. It's kind of like a janitor's key ring, and all the keys on it. Those are all keys to accounting. We have an equipment T account here. Equipment are things that a business buys that they're going to use over multiple periods, a month, years, things like that. So maybe for Walmart, the cash registers might be considered equipment. If you're thinking about Kroger, maybe they have a forklift that brings in stuff off the produce truck into the produce area so they can unload it. That's equipment. Again, that's an asset. We can use that to operate the business and make money. So it's on the asset side of the accounting equation, that left-hand side. You know where I'm going with it. If it's on the left-hand side, it goes up on the left-hand side. The left-hand side's always debit. Right-hand side, always credit. We buy equipment. Equipment account goes up. We'd have to have a debit. We get rid of that equipment. We sell it off. We trade it off, whatever the case might be. It gets destroyed in a fire. We don't have it anymore. We'd have to take it out of equipment. We have lower equipment. We lower it with a credit. So, 2 new accounts on the asset side in chapter 2. We've already talked about a note payable when we borrow from a creditor, whether it be dad or the bank. We owe them money, got to pay it back. We have a note that spells out what we owe, when we have to pay it back, any interest involved. It's on the right-hand side of the equation. So note payable goes up on the right-hand side. That's the credit side, right? We borrow money. We have a liability. That liability needs to go up. We pay off that note payable. It needs to go down. All right. The other new account we've already mentioned, common stock, evidencing the amounts of money that the owners have put into the company. Right-hand side of the equation, it's going to go up on the right, down on the debit side, left side. So, chapter 1, every time we had a transaction, we put it right to those T accounts. And we just kind of plug it right in there. And that's good for example purposes. It kind of helps us understand how things go up or down in those T accounts. The problem is that's not really the way it's done in real life. In real life, we begin a transaction in another place, and then it kind of gets posted over to these T accounts. All right? So that's what we need to kind of talk about today. The place where we're going to originate the transactions and spell them out initially before they go into these beautiful T accounts here. There's all my T accounts set up. We got them labeled. We got the beginning balances. Brand new company. None of these have any dollar amounts in them yet. All have a 0 beginning balance. So we got asset accounts, liability, owner's equity, and you can see each individual account listed down through there. Now, all these accounts together comprise something called the general ledger. And all of these dudes here, regardless of what side they're on, are called ledger accounts. And what these ledger accounts are doing, they're keeping a running balance of what's in that individual account every time a transaction goes through. Okay? So, if we have a transaction that involves cash, it's going to hit this ledger account here, and we can see that balance change in real time. So that's the general ledger. All the accounts put together, where we can see the individual accounts and how they're changing as we go along. So general ledger contains all the ledger accounts in the accounting system. All right? Like I said, we're not going to post directly to those when a transaction happens, like we did in chapter 1. Here's what's going to happen. We're going to do something a little bit different. In the real world, instead of posting directly to those T accounts, we put transactions into something called the general journal. So there it is, beautiful journal that we're going to use to record transactions. So we're shifting gears a little bit here. Instead of plugging them right into those accounts, we're going to start spelling them out longhand. That's the way it happens in the real world. In the real world, a transaction begins in the journal, and then usually by computer, it's automatically put into those individual ledger accounts. All right, so here we go. In the journal is where we're going to start with our transactions. They're going to originate here, and then they're going to post over to the ledger. I'm going to show you that process. The one general rule of thumb that we like to do on the journal when we're putting in our transactions from a formatting standpoint, we put the debit entry on top, we put the credit entry on the bottom, and indent it a little bit so it's easy to read. So here we go. We're going to walk through a few transactions, and I'm going to show you how to put them into the journal, and I'm going to show you how they're posted over to the ledger. Everybody with me? You take a deep breath, get a drink, maybe some water, and we'll plow through here. All right. January 1, a group of investors put a total of $10,000 cash into Gray Company, and those investors get common stock to show that they've invested in the company. January 5th, the bank owns $8,000 in cash to Gray Company. A few more. On January 10th, Gray Company buys $5,000 worth of equipment, pays cash for it. And then on January 31, Gray Company buys $7,000 worth of inventory, pays cash for it. So we're going to journalize every one of those transactions. And then I'm going to show you how they get posted over to the ledger. We need to, first of all, put the transactions into the journal in correct format, post them over to the ledger, and then once all the transactions are made, we'll calculate those ending balances like we did in chapter 1, and then we'll make a trial balance, make sure the accounting system's all balanced out, and we'll make a balance sheet. It sounds like a lot, but it won't be too bad, I promise. So here we go. How do you make a journal entry? We're getting ready to make a journal entry here. Pretty exciting stuff. And for a lot of us, it's going to be the first journal entry we've ever made. Wow. Hopefully, the first of many, many, many journal entries. January 1, a group of investors put $10,000 into the company. So as you read accounting transactions, you need to start training your brain to think, okay, what accounts are involved here? What is happening? Don't so much focus on the amount right now. Think to yourself, what are we getting? What are we giving up? What's going on from an account standpoint? So every journal entry is going to have a date. 1/1. Group of investors put $10,000 into the company. So we're getting something. We're getting money. We're getting $10,000 in cash. Okay? And we said that we have a new account that shows what is given in return for that. Common stock. Common stock is evidence of an owner's investment in a business. So we got cash coming in, and we got common stock. We'll start with cash right here. $10,000 is coming into the door. So is cash going up or is cash going down? Ask yourself that question. Is cash going up or is cash going down? Well, it's going up. We're getting money. Our cash account on the left-hand side of the accounting equation. How do I make that go up? It's on the left-hand side. It goes up on the left-hand side. So cash is going to be my debit. I'm not going to plug that in there right now. I'm going to come up here and make my entry. Cash is going to be my debit. Because I need to make that account go up to reflect the fact that I got $10,000 I didn't have before. Boom. My credit, common stock. That credit to common stock is going to make the common stock account go up because it is on the right-hand side of the equation. As I mentioned in chapter 1, every transaction you do has to have an equal amount of dollars on the debit side and the credit side. I could have 10 debit accounts and one credit account, but the dollar amounts have to equal. Dollar amounts on your journal entries always have to equal debit and credit. If they don't, you're wrong. So I've got my debit on top, got my credit on the bottom, a little bit of an indent, and then I can write a little description under it. And you're just going to put, that description isn't part of the entry, per se. Just kind of describing what's happening. Issued stock for cash. Boom. All right, so that's a journal entry. That's all there is to it. We're writing out the transaction longhand. And that's kind of what that journal is for. And that's where a transaction really begins. What happens at that point, usually in the computer, when you put that entry in, there will be a button to post it to the journal. And when you post it to the journal, automatically it's going to carry the amounts into the ledger accounts. All right, so this part right here is called posting. Posting to the ledger. I'm posting the journal entry to the ledger accounts. All right, and you'll notice I didn't flip anything around. I didn't turn any debits into credits. All I did was just copy it. Cash debit came down to the debit side of my cash ledger account. Common stock credit came down to the credit side of the common stock account. That's the game we're playing now. I'm going to originate our transactions in the journal and then post them over to the ledger account so we can keep a running tab of the balances in each individual account. Boom, there you go. If you're clicking through Solid Footing and you're doing the Excel spreadsheet in Solid Footing, that would be the representation there, just like I drew out on the PowerPoint slide. Moving ahead, January 5, we got a bank loan. Went to the bank and said, hey, we need money. The bank said, hey, here's a check for $8,000. Pay us back later on plus interest. All right, cool. So what's going on here? Think about what the transaction's saying. We're getting money coming in, and now we owe somebody some money. So what needs to go up? Well, we're getting some cash. Cash is going to go up. So we'll start there. We know how to make cash go up. It goes up on the debit side. $8,000. So now what's our other account? I've got common stock down here. Are we dealing with common stock? Well, no, because common stock is evidence of ownership where people have invested in the company. The bank isn't investing in the company. They want to get paid back. They're loaning money. So that would be a note payable. We got to pay them back. Payable. So note payable is going to be our credit. $1,000. A little description if you want to throw in there. Borrowed from bank. All right. Perfect journal entry right there. Debit on top, credit on the bottom, indented. We got our debit, we got our credit. Dollar amounts are equal, debit and credit. So now we got to post it over to the ledger accounts. 8,000. Debit to cash. I have a credit. Note payable. 8,000. 18,000 on the asset side. 18,000 on the liabilities and owner's equity side. Got that transaction from January 1 still on there. So, 2 journal entries down, 2 more to go. I couldn't be more excited. There's our updated general ledger with all the accounts on it. Straight out a solid fitting Excel spreadsheet. We move forward. January 10 rolls around. We go out and we take some of that money that has been invested into the company and loaned to the company, and we buy equipment. Great company buys $5,000 worth of equipment. Pays cash for it. All right. So we got equipment and we have cash. We got the 2 accounts identified right there. Which one's going up, which one's going down? Well, obviously, if we're paying cash for something, cash is going to go down. If we're getting equipment, equipment's going to go up. Both of those are asset accounts. So here we have kind of a fun transaction where everything is happening on one side of that accounting equation, on the asset side. We're trading one asset for another. One's going to go up, one's going to go down. The one that is going to go up, remember, assets go up on the debit, down on the credit. The one that's going up is equipment. We are getting equipment here at Great Company to the tune of $5,000. And our cash account's going to go down. We had to write a check for it. Paid for that equipment, straight cash. All right. So if you're looking for a description here, all we did was bought equipment. I'm going to say for cash. I'll put that down there so we know how we got it. We paid cash for it. Now, post it to the ledger accounts. Equipment, $5,000. And our cash account going down $5,000. So, again, the whole point, and nothing happened to inventory. I didn't have anything going on in inventory. I got my debit. Got my debit right there in the equipment. My credit to cash. That entire transaction is happening on one side of the equation, but my debits and credits still equal in dollar amount. So, as I mentioned, the whole point behind the ledger accounts right here, they're keeping a balance in that particular account. Everyone is giving me the current real-time balance in the account. All right, so if the boss comes along and says, hey, what's in the cash account? How much do we have in the cash account? I'm probably not going to go to the journal here, because the journal, if I want to try to figure out the balance in cash using that, I got to look at all the transactions that involve cash. I got to look at them separately. But if I look at the ledger account, oh, look right there. It's summarizing, and it has been summarizing them all along. Hey, boss, we got $13,000 after that purchase of equipment. Finally, we get to January 31, end of the month. Let's go buy some inventory. We've got to have something to sell. We've got to have inventory. Great company buys $7,000 of inventory, pays cash for it. So inventory is our new asset account we talked about. And we're getting inventory. That must mean inventory is going to go up. If we're paying cash for it, that must mean the cash account is going to go down. So if I'm going to make inventory go up, it's going to take a debit. Well, how do you know that a debit makes inventory go up? Remember our rule of thumb. If it's on that left-hand side of the accounting equation, on the asset side of the accounting equation here, it goes up on the left, on the debit side, down on the right, or the credit side. I knew it because I have that memorized, and you're going to have to memorize that too. We'll practice it. Hopefully by the time we practice it a few times, you will have that burned into your brain. And we bought some inventory. I'm going to write a little description on that transaction. Bought inventory. With cash. Boom. There we go. Now we got to post it over to the ledger. I got $7,000 on the debit side for inventory. Post it over here. And it took $7,000 of cash to buy it. There we go. That's the game we're playing. That's accounting. In 2 weeks, you know basically the entire foundation for getting a transaction into the accounting system. Pat yourself on the back if you're still here. All right. Up-to-date ledger account here. I'm down to $6,000 in cash. I got my inventory. I got my equipment. Note payable. Common stock. You can see my ending balances. 6 and 7, 13 plus 5 is 18,000 on the left-hand side. A note payable. Common stock. I got 18,000 on the right-hand side. So remember, holistic, perfect accounting harmony. We're always in balance. It's yin and yang. Yin and yang, I guess I should say yin and yang. I butchered that, didn't I? But it's always going to be in balance on the two sides of the equation. They're always going to equal. Otherwise, we got a problem. So we've done 3 of the 4 things we need to do. We put our transactions in the journal. I posted everyone over to the ledger. We calculated our ending balances in the ledger. And now it's time to do our accounting reports. First stop, trial balance. We're trying to see if our accounting system balances. Trial balance. And again, on the trial balance, we're going to list out every single account in the accounting system and the ending balance. Super important that we take that ending ledger balance and put it on the correct side, the side that it's on here. So, debit side, we're just going to fill in the numbers here. If you're feeling a little brave, you can work ahead of me if I'm writing too slow for you. Here's my 6,000, my 7,000, 5,000 coming down here. All right, now I got note payable on the credit side, 8 grand. Common stock, 10,000. Now we've got to do a little bit of addition. I'm going to add those up. 18,000 on the debit side and 18,000 on the credit side. We equal. The accounting gods have smiled upon us. That's exactly what we want to have happen. If you do your trial balance and you don't equal, you got to stop. You got to stop with the accounting and go back because you have boogered something up and you got to go back and fix it. We haven't boogered anything up here, amazingly enough. So now that we've got the trial balance and we know the accounting system, debit and credit, is equal and in balance, we can start making our accounting reports. Here we go. The balance sheet. Remember back from chapter 1, that balance sheet, pretty important. It shows what we own, our assets, and who has a claim to it. Creditor or an owner claim. Okay, so what do we own here? Well, we own the cash. We own some inventory. And we own a little bit of equipment. 18,000 in total assets. And be careful. We'll do some balance sheets as we go along. And some people have the tendency they want to abbreviate. And they want to make things a little bit easier, take shortcuts and abbreviate things. You got to be careful in accounting when you abbreviate. You don't want to abbreviate assets and offend anybody. So just be careful if you're taking shortcuts, you're abbreviating. Just try not to do that too much in accounting. You don't want to offend anybody. Note payable, 8,000. Total liabilities, I can do the math on that. It's 8,000. Common stock. So total equity, 10,000. We're going to add together equity and liabilities, 10 and 8. 18,000. Balance sheet has to balance. Your assets have to equal liabilities and equity. And they do. So there we go. Now, you all that are maybe paying really, really good attention right now, you may be looking at that and saying, oh, this is so dumb. All we did was do a trial balance and then copied the exact same information over to the balance sheet. What's the point? We're doing the same thing just twice. It just seems really redundant. I ask you to be patient because what's going to happen is in chapter 4, we're going to introduce a few accounts that aren't on the balance sheet. They have a whole nother accounting report that they're going to appear on. So that trial balance is going to have all these accounts that we're going to add in, and only some of them are going to be on the balance sheet. Okay, so we'll have a second statement that we'll introduce to kind of show you why we need the trial balance, and it's not exactly the trial balance and the balance sheet are the same thing. Because that's kind of what it looks like here, but that's not the case, I promise you. So congratulations. We got done in half an hour here. It's a flurry of accounting activity, as I like to say. We completed an entire month of grade company accounting for the month of January. But we haven't sold anything yet. That's where we're going in chapter 3 and 4. We're actually going to skip chapter 3 and go right to chapter 4. But that's what we're going to do. We're going to start selling stuff. We're going to open the doors. Customers are going to come in and they're going to buy that good inventory we bought. And maybe they'll give us money. Maybe they'll give us an IOU. Tell us they'll pay later on. But in any event, we're going to start selling stuff. And if we're going to sell stuff, we're probably going to have labor. We're going to have some people in there running the register, taking care of the customers. We're going to have to pay people. So we're going to be selling stuff. We're going to be paying people. We're going to have rent going on. Got to pay the rent. We got all kinds of stuff going on. So that's where we're heading in chapter 4. Before we do that, though, we have chapter 2 homework in solid footing that I'd like you to tackle. The details on that are in Canvas, as always. If you have any questions, I'd be happy to help you out. And we'll tackle chapter 4 in solid footing next time. We'll see you there.